So next up on our journey from knowing a little bit about CFDs, a little bit about Forex trading, I want to talk about futures as a complement or as an alternative to CFDs. Now, if I just Google what are futures contracts, I will get this kind of explanation from the search engine. They are legally binding standardized agreements to buy or sell specific assets such as commodities, indices, currencies, blah, blah, blah. Lots of stuff, lots of information there. And if you look it up a little further, you'll get these ancient descriptions of how the Chicago Mercantile Exchange back in the 1850s started trading wheat contracts because farmers were needing to have some security over their future crop harvest and income related to that. I mean, if you're academically interested in all of that, fine. For me, that didn't explain anything about what futures contracts really are and how to trade them, how to profit from them. So I'm just going to break it down really simple and really quickly. I will make some long form content as well on this, but for now, it's just briefly. Practically speaking, a futures contract is just an instrument that you can buy or sell in the market, and you can do that through digital platforms, any kind of broker interface that you can sit on your laptop and trade. And these futures, the value, the price of them will be tracking underlying assets. That's why they're also called derivatives. They are derived from underlying assets. That can be a stock index such as the S&P 500. It can be commodities such as gold or copper. And like in the old days, it can be crops like wheat, corn. It can also be things like cattle, if you can imagine that. But in the end, what you're left with is a digital interface like this, where you can buy and sell in the market. You can place orders for price to go up or down. You're betting on the fact that price goes in this or that direction by buying and selling. And then you can exit the market again when it's reached the price that you want, and you can profit from that. Of course, you can also lose money, and there's leverage involved. It means what you're putting in, you can get more out of that. It's like basically a mortgage where you are borrowing something to make a larger profit or a larger loss. So you're taking on a lot of risk. That means risk management is really key. But in essence, futures trading is just about clicking buy and sell in your digital platform and trying to turn a profit from that. Simple as that. Now, in the next episode, I'm going to dive into how that actually works. I just wanted to leave you with this message. It's not scary. In fact, I have people saying that day trading is more safe than long-term investing because you always have a stop loss in there. You always have your risk tightly controlled. So it's pretty simple, actually. So stay tuned for the next episode. We'll dive into the practicalities of futures trading. How are you going to place orders? How are you going to steer and manage your risk? And what happens to the trade once it's on?